Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yes. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And
excellent.
With that, let me share my screen. If you guys are joining us for the first time, Will and I, we do this show in the mornings to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom on the live chat on YouTube. If you click on that, it takes you over to Zoom. Once you're in Zoom, there's a button at the bottom that says raise your hand. Click on that. You don't have to turn on your video camera, but once we let you in, you can ask your question live and direct. If you prefer to type your question in, you could also do that on the live chat on YouTube. Type in your question, Will's watching it, and he'll read it back to me. And while we're waiting for questions to come in or more people to join us, we'll start out taking a look at the pre-market report. And these are stocks trading in pre-market hours. See if we could get some insights, what's happening in the morning. If we do get questions after that, Will let me know. We'll take the questions. If we don't have any questions, I'll try to either navigate to a different part of the website to get some more insights, or default to some questions I get over the email. Okay.
Perfect.
So pre-market report. These are stocks that are trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 75 stocks so far made our percentage gainers list, 38 on the decliners list. So from this perspective, it looks like we're setting up for a bullish bias at the open. Just a couple observations here before I try to
bank stocks are still getting hit a little bit, huh?
So the bank stocks still in the news. Looks like Credit Suisse, they right here, that's the one most active, down 57% in the morning. Of course, over the weekend, they I guess you could call it a bailout, right? Another bank with the support of, government guarantees bought Credit Suisse, UBS, right? So they bought them, like they said it in their press conference, because this was basically an emergency bailout, right? Or it was an emergency to get them, somebody to take them over to stop the panic. And
let me ask you something.
Yeah.
Who bails out UBS if something happens to it next?
That's becoming right. This is what the fear is. And I think at the same time, what's happening behind the scenes is that there is a lot of liquidity starting to get pumped into these banks, right? So the Fed, after the collapse of SVB, the bank then allowed a liquidity window for banks to go in there and access. And I think it was like, I don't know, so far $165 billion, funds were accessed from that window. They're pumping in more money at this now again into the system. And we're seeing, the interest rates make, historic moves, as far as like the magnitude of the moves moving down in a very fast, on the 10-year, I think the 2-year was paying 5%. It was a 5%, went down below 4% at this point, very quickly. So people are really moving money around. Those credit markets, are very volatile right now. But at the same time, you've got two things pulling on it. What the Fed I think, is doing and what interest rates are doing are more inflationary, but then you do have people worried, oil prices coming down. So those are kind of certain things that are deflationary if credit is tightening up. So it remains to be to be seen, really. And I think one of the things that's going to come out of this is, and we'll take a look at Credit Suisse, maybe what happened in the options market. Let's take a look at what people were thinking on Friday. But going back, and I was thinking about like what Kathy was saying, that we might at some point see the end of the brick and mortar banking system. It's becoming, the more you have to bail them out, right, the more that people realize these are systemic problems. And you even have congressmen said, I think, like Elizabeth Warren was saying, make banks boring, make their businesses boring. But what does boring mean? Is it just like an intermediary for holding funds and allowing you to move funds, pay bills and deposit funds? Because if that's the case, why not? You could have, you don't need your traditional brick and mortar in these big banks, right? You don't need, because first, certainly these banks and the big banks like JP Morgan, Goldman Sachs, the things that they're engaged in are pretty complicated, right?
But that's the difference in the banks, right? Like SVB was, they were entrenched in Silicon Valley. So they were given loans and doing things within that network and that community, which led to like large deposits. But I know bankers in different parts of America that are making, loans to the community, whether it's a restaurateur, another small businessman, a card, they're dealing with local businesses in their areas, right? And bankers literally know the people, right? Know the people who are, developing the properties or starting the businesses or getting a loan for a new restaurant. They know their track, and it's hard that, that doesn't exist if it's just a simple, put the money in and make sure the money's safe so you can get it out, and write a check against, it's good. It's got to be, there's more to it. Right.
Well, and that's what what does that mean? Is it, you limit because, you do have FDIC insurance, you have access to the Fed window, you have all this stuff. So do you limit banks to those activities? Because certainly banks are engaged in lots of activity, some are investing in startups, or funding startups and
but at the end of the day, doesn't seem like that was the risk at SVB, right? The risk was actually that they made a decision to put a lot of their deposit money in long dated US treasuries. That was the risk. All banks have to take some risk, because when they grab deposits, they invested in something, right? Something that yields. They don't put the cash into a vault. But I think SVB, the problem was not so much that they lost on their bonds. That's not what made them fail. It was because their depositors were in businesses that, after they deposited, had to withdraw money to pay their bills, right? Like, for example, a person who has a bank account, they have to pay bills, right? They pay their electricity bill, they pay this, but then they earn money and put more money in there. What was happening with SVB is that a lot of their customers were startups that didn't have money coming in. You know how they got more money coming in?
Huh?
You know how they got more money coming in?
It was like a pyramid, like a pond.
Yeah,
right?
they needed more investors, right? And when the investing money dried up,
so
there was no more money coming in.
Right. So people were not fleeing the bank. They were just accessing their money. They said, okay, I put all my money in, here's a startup. They raised money, $5 million. You're a biotech company. So every month you spend money on your research, development, your employees. So you're drawing on that. And what happened was that SVB over time saw that their customers were drawing on their deposits and they had to raise more money. And then they couldn't hold on to the asset to maturity, right? They couldn't hold on to for 10 years on this bond. They had to sell it to raise money. And they probably maybe did it in a wrong about way that created, a panic and a run on the bank. But it was the run on the bank. It was the 10-year bonds. It wasn't like they were selling credit default swaps. You know what I mean?
No, it was to get access to that money that was invested in the bonds. They had to sell it and show a loss, and that led to more. People promoted it as more risk to the bank and a potential bank failure. And it led to more and more people withdrawing their money.
Exactly. And, that's what the problem was, is that their customers were drawing every month. They weren't in businesses that were cash cows. They were in startups, and startups spend, right? They spend until they could, develop their product, create a market for it and sell. So that was a niche, that they were catering to.
Yeah, and the Fed is now taking that duration risk off the table, right? Any bank can take long dated bonds and get par for it to meet withdrawals. So it's not an issue now.
Yeah, banks take risk. Banks are in the business of taking risks. They have to take your deposits and put it somewhere, right? They put it in treasuries, So they had duration risk, but they didn't, they didn't have, they would have gotten their principal if they were able to hold it to maturity. But that was, so if you make banks boring, what does that look like? Because, look at JP Morgan, Goldman Sachs, Citigroup, they're engaged in trading and clearing trades and wealth management in IPO markets. And they're not traditional banks, like the community banks. They're engaged in lots of businesses there that are, I wouldn't consider, it might be boring to talk to, but they're not boring from the sense that it's easy to understand. You take a deposit, you put it in a treasury and earn it. That's not what they're doing. And you could take a look at Goldman Sachs. I mean, they just tried to get into the retail business, right? Into the retail banking.
Yeah, they've been trying for years and lost a lot of money. It's not, the local community bank is, there are lots of them and each one is different, right? And they're dealing in their community and, they're providing a needed service that has existed since the beginning of the banking system, right? That's how it works. Yeah. And it's, it's relationship based, business based on businesses in those regions. And, it's,
I think the question is,
it already is pretty basic banking, right? Most of those banks are pretty basic. It's the big banks with the systemic risks that are doing a lot, right? And at this point, they don't seem to be the problem. It's not like there's an issue and people are fleeing Bank of America or Goldman Sachs. It's not.
Well, they're not fleeing them. I think the question then becomes is that if you're engaged in this risky business of, catering to certain types of, riskier depositors or in a business like Goldman or JP Morgan or, where you've got, you're not just doing traditional banking. The risk is that, they're also FDIC insured, right? They also have access to, the Federal Reserve. They have, this is what makes it risk, right? That these kind of implicit guarantees from the government, the access to government, leverage, they're using that for non-traditional banking, and that could be creating the systemic risk where it's not born, and I'm not sure what Elizabeth Warren, but that's what I think she's saying is that, well, if we're going to insure depositors, if we're going to give them access to the Fed window, if we're going to give them preferential treatment on, liquidity and interest rates, all this, then let's take it, let's take all their business, all the other stuff away, because those are the risky things that bring things down. No credit default swaps, no, none of these other, over-the-counter derivatives. All, those are things that make things very risky, right? Let me narrow down this list, Will. As we're looking at it, you see that there are a lot of pre-market stocks trading, and it could be small cap stocks, it could be an ETF, it could be a preferred stock such as this one over here. So pretty much anything that's listed on a major U.S. exchange and it's trading in pre-market hours and meets our thresholds, make this list. So what we want to do is narrow down this list to a smaller group of stocks to get a better focus of what's happening. So I'm going to use these filters here, and this one in ETF, and I drop it down, and you get to select from a list of other ETFs. Some of them are sector ETFs. Top ones are broad-based ETFs. Let's select this one, SPY. That's S&P 500 ETF. And what this will do is filter the list down below by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we do see 23 stocks made our percentage gainers versus 200 decliners. So from this perspective, looks like we're set up for a bullish bias at the open. Yeah, and I don't know, well, if you don't have questions, I guess I could go to take a look at what happened with Credit Suisse on Friday.
Yeah, that'd be great.
So let's see, what's Credit CS?
That's CS, yeah.
Credit Suisse. And here we see down 55% this morning. Of course, they got that deal where there's another part of the deal, I think, was that certain bondholders got wiped out, but the shareholders, equity holders, they certainly lost, but they didn't get completely wiped out. So they're getting, whatever from Friday's close, they're getting a third of that, it looks like, right? Something like that, or less than half of that from this morning. And that also raises questions because, that's not how things are usually structured. Usually things are structured where bondholders come before the common stockholders. You got, and preferred stock come before even the equity holders. So they changed the rules there a little bit. I don't know what the consequences will be, but certainly, some of the bondholders,
the laws of unintended consequences.
Yeah, where the equity holders are usually the last in line to get anything from when a company fails, they're the last creditors in line. And here, they made it a little bit different. I'm sure maybe they had reasons. I don't know exactly, but there are questions about it. Why do equity holders, why do they get anything out of it if certain bondholders were completely wiped out, to zero? I don't know, look, maybe they didn't want to panic the equity markets. Maybe they thought that was more important, not to panic the equity markets. But those are things that in this deal, it is a little bit unusual because then they change the rules, right? They changed the rules of the pecking order. Let's take a look at the order sentiment here. And this is on Friday, where everybody kind of already was talking about Credit Suisse and what's going to happen, and what kind of bailout they might need. And this is just looking at what the incoming order flow looked like in the options market. So overall, looked like, as far as delta goes, so we measure the cumulative balance of incoming deltas coming in, was bearish, about 600,000 deltas, which might not be that much on balance when had 117 million shares traded hands. Okay, and this allows us to take a look at, like, what do we think the options market, the potential impact on stock volume. So if we just measured incoming positive delta versus incoming negative delta, it made up about 9.4% of the volume. So you could see that not a huge amount coming from the equities market. All right. Somewhat, definitely a little bit of an impact, but not. There was a lot of repositioning going on, obviously, by long-term holders here. If we come down here, it looks like it started out positive, then dropped to negative, and here it kind of gives us the top 10 deltas by option. So the biggest delta came from the March 24th 2.5 put. Looks like -1 million deltas there. In other words, people are buying puts, because buying puts creates a negative pressure, right, on the delta. Some positive delta came from the March 17 puts, which expired Friday, which may be an indication that people were rolling it, right? People are getting out of some of their puts that were expiring, rolling into the next month. So if just looking at the top 3, because these expired, right? So they ceased on March 17th. Either you had to close out of them, or they would have gotten converted to stock because they were in the money. Well, I don't know if this one was in the money. Let me see. It's not the 2. This one would have expired. This one was in the money. Some call selling here. So this is kind of just the top 10, showing you how how we interpreted the order flow and the delta pressure on those options. And then come down here. This breaks down the deltas based on the order size incoming, right? So we look at the order size and we aggregate certain orders that we think are part of one order. And then we take a look at the order size to get an idea, where can these orders, what type of traders or accounts these orders could be coming from. And you could see here that the small retail and retail slightly positive on balance. Then we got the pros and institutional orders on the negative side, selling delta. You can see all 3 were way higher than the average. The notional volume way higher than the 30-day average. This is the vertical spreads, but not much going on there. This is kind of leading up to it, a lot of bearish bias. So that was just the way it was leading up to it. If we had to take a look how much pressure just from the equities market, we could see that a lot of this looks to me, some coming from the options, some perhaps hedging positions, some maybe positioning on what the stock might look like. But this is telling me that there's a lot of holders just rotating out, right, or coming in, but it wasn't a big portion coming from the derivatives markets. We didn't get any questions. Well, we have 4 minutes left, so I might leave it there.
Let me see. Yep, no big questions showing up.
Okay.
Awesome job, dude.
All right. Well, everyone, thank you for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
All right, great job. Have a great start to the trading week, everybody. Thanks, Steve.